increasing mortgage rates are having a significant impact. In fact, they're sidelining real estate price escalations and actual multiple offers. So let's go through a bit of the metrics. Let's talk a little bit about what to expect. More importantly, let's go through and figure out how best to manage what's going on. So remember to subscribe. Remember to hit the bell, hit the like. That way people that are similar to you that are looking to make a really good business decision, hey, they get this information. That's what it's about. It's free, so there's no cost. There's no obligation, hence free. Anyway, so let's talk about what's going on right now year to date, and we're going to talk about a little bit of what happened in March as far as our metrics and where we're going, and then what the heck has been happening the last 3 weeks in our mortgages. It's crazy. All right, so first, year over year, our inventory is technically up 300 homes this year over last year. All right, new on market is up 0.3%. It's just a really small number. 0.1% above or below where we were at for pended. So we dropped down just a tiny little bit. And then as far as solds, we're down 8.1%. It's about 1,500 homes. Not unexpected because, again, our inventory is just less. I know this is not 1,500 homes less, but there's just a lot fewer homes, a lot fewer options than it was last year. Last year we had more options to consider, and now we're starting to see a little bit of, well, some interest rate increase. If you've been watching the channel, you know this is going to happen. We know this, and we're going to talk a little bit about what's coming. All right, now, when we take a look at March, just March 2021 and March 2022, number of homes actually available, we're up 550 homes. We were up 764 new homes on market. And then, of course, we were up 365 homes, or 4.5% on homes that went pending. And then, of course, we're up 77 homes at 1.1 months. That is the month of March. So still seeing some really good numbers and whatnot. We're going to start to see a little bit of a taper. Now, we're not going to see a fall off. Yes, okay, so rates, when we come down here, we were seeing in December, remember, when we called it the $100,000 haircut? Everybody loved that one, including myself. I do crack myself up. So in December, we were at 3.11%, right? In basically April, 5%, which is where we're at. So every $500,000 has an increase of basically $537 a month. Wow, that's a significant amount. So if you're dealing with some of the, like the East Side average, which is closer to 950,000, or Seattle, which is about 800,000 and change, 825, I think, or something to that effect. Okay, well, that's not $537 a month. That's like almost $1,000 a month, $750 a month on top of your payment that you were doing in December. Okay, so for those of you that were waiting for the market to come down, and you're thinking, oh, it's here, the market's coming down, she's gonna crash. Hold on to your pantyhose. I don't see that happening, and I'm going to explain why. Let's get back here. In fact, Dan Golden and I were having a really fabulous conversation about where we're expecting things to go, what's going to happen, where, when we talk about the feds. And in fact, what's going to be super important again for you guys to differentiate what we talk about when we talk about mortgage rates and Fed rates. So I printed off one of the mortgage rate tickers, okay? And as you can see, that is a stock market ticker. Now, this is January, and you can see, over here, there we go, how it came down. Notice when it goes down, mortgage rates go up. When you look at 2018, you can see value of the bonds came down on this ticker. Interest rates were at one of their almost highs. Well, it was not more than almost, it was. Then when you take a look at December or January 2020, you notice that it went way up, okay? When the bonds and the mortgage-backed treasuries are performing well, interest rates come down. Okay, well, there's a lot of volatility, a lot of craziness going on in our world right now. And normally, we actually see an improvement in bonds and mortgage-backed securities, which is awesome, which means that brings rates down. But because there's so much volatility, there's a lot of unknown things. And when we piggyback some of the comments done by the Fed chair, like when they said, hey, we need to raise federal funds. Now, okay, when you hear the Feds talk about raising rates, okay, again, that's not mortgage rates. Mortgage rates, bonds, 10-year treasuries, mortgage-backed securities, publicly traded, okay? The Feds deal with your HELOCs, your home equity line of credit, your credit cards, your car loans, any type of adjustable business type of loan. That is the money that they're talking about, the lending element of that before commercial banks and whatnot, add their premiums on top of that, or, par pricing plus, okay? Now, so if you have a home equity line of credit and it is not fixed, you have better pay attention, because here's the thing. What the Feds intend to do is to get what we call a neutral rate. Now, a neutral rate means that it does not benefit either the economy, nor does it hurt the economy. Called neutral, meaning it's in the middle. It doesn't help, it doesn't hinder. Okay, but here's the thing. So the Fed rate right now is at 0.25 to 0.50. Okay, they want to raise the rate to 2.40. That means that if you have a credit card, you're going to gain 2% on your rate. If you have a HELOC, you're looking at a 2% increase. If you have an adjustable rate mortgage that is adjusting, meaning it's outside of its fixed window, it's going to start going up. You need to fix that like pretty soon, or come up with a different option, because what they're going to do is continue to raise that in 0.25% increments to get to 8%. Their logic is that if they make that neutral, that's going to stifle inflation. Well, I'm sure that during Jimmy Carter's era, when interest rates got up to 13, 14, 15%, they thought that they were going to find neutral territory there too. They weren't very successful, and based on what we're seeing and what they're trying to do and the logic they're putting behind it, now granted, they have more brain cells than I do, for heaven's sakes, but common sense says that is not going to be a great idea. And, well, there's a lot of other people say it's not a great idea either, other than myself. All right, so with that, when we take a look at what we're doing market-wise, some people are saying, George, holy smokes, prices going down. No, I don't see prices going down. What I see is a curbing, and you might remember a week ago or so, we said that higher interest rates could help buyers. And buyers out there going, hey, interest rates are going up. How's that going to help me? And you said prices are going to go up. And you gave that analogy to Mike Tyson. Give me the boom, boom, the 1-2 punch. Well, yes, short term, we're going to still see prices going up. We're still going to see interest rates going up. In fact, I know you're gonna hate this. In the next 90 days, we could bump, boop, maybe not go over, but at least start bumping up next to 6% mortgages. And that will be interesting to see. It'll do a lot with what's going on with our administration. Every time that the Feds make one of their halfway, I don't want to say wackadoodle comments, but one of these comments where they're going to start raising rates, big investors, the industrial investors, start to have a little bit of heart palpitation. And when they have heart palpitations, sometimes rates do not go, or things don't go the way they really should. So we just need some duct tape for their mouth. Anyway, keeping things on track here, when we take a look at our 7-day running average, new on market was 1,479. That's a great number. This is April. That's a great number. We should start to be getting into the 1800s on new on market. Same thing with pending. 1,634, still taking off more homes than we brought on. Still have 5 to 8 days worth of inventory depending on the day of the week. Friday's a big list date, and great things happen. Sold 1,405 homes sold. So we are still seeing that increase in coming on, going off, closing sales. Now, When we take a look at interest rates, we're at 4.875 to 5.125. Okay, non-owner occupied, that one took a wee bit of a jump. They're getting up close to that 6% mark. So yes, they're still advantageous. Yes, you're probably going to have to put down a little bit more to make some of those investments pencil out right. For those of you that missed the 3 and 4% mortgage rates, sorry, will they be back? We might drop down into the high 4s. It's going to be brief. I think that as we start cresting into the 5s, for investments, I think that non-owner occupied is going to stay closer in the 5s. They might bump down into the 4s, but not very often, not very long. So keep that in mind. And a lot of that's going to depend on what our mortgage-backed securities and 10-year treasuries are doing. Super important. So some of you are saying, okay, George, you're saying that you don't see values coming down. Now, I do, however, and if you watch prior episodes, you'll hear me talk about towards the end of this year, we're going to start doing a flattening trend. Doesn't that sound about right? Okay. For those of you folks out there, a flattening trend means that we tend to flatten out, not go down. Why? Because when you see this chart, this is what a normal market looks like. The light green are homes available. Dark green down here, those are homes that sold. And as you can see from this point right here, which is about 2020, January of 2020, we saw the whole market flip where we were selling more homes than we had homes available. And it was thankful that we had the number of new homes coming on market. But as you can see clearly right there, our inventory is still horrifically low. Okay. Well, what does that mean? Well, that just means we're going to start curbing some of these escalations. We're not going to see the crazy escalations. Hopefully, maybe not. Some of these insane escalations that we've been seeing. And, multiple offers. If you had 10 multiple offers before, maybe you're only going to get 2 or 3 or 1 to 2. Okay, so it will be a little bit more tame, a little tapered. All right, it won't be the insanity that some of these offers are seeing, which in many regards for buyers, that's going to be very helpful. Why? Because you're going to start to see that pricing start to moderate, and that will be super important. Okay, when we have the millennials that make up 43% of home buyers and baby boomers account for 42% of the sellers, that's at least according to NAR's Generation Trends report. Okay, when we start to see that type of momentum still happening, because remember, the millennials, they're still pretty young, even though they're capping out in the early 40s, they're really trying to make that push to get that American dream, and they can achieve it. They're going to just pay a little bit more for it. Let's take a look at days on market. This is going to be an important chart for you guys, because as you see right here, days on market. Okay, so that one is at 14 days on market on average. That was for March. March of last year was 18 days. And as you can see, it has, and this is super important for weeks coming, you can see it goes up and down. It always does. Same thing with our sales sold price to list price ratios. Okay, so last year we were at 105%. That means that a home sold for 5% more than it was listed for. We're at 108%, meaning we're 8% more than what the home was listed at on average. Okay, that's the entire Northwest MLS, Canadian border, all the way out to the coast, part of Eastern Washington, and of course part of the Olympic Peninsula. It's a pretty vast area. Now, all things considered, those are great numbers, because if we take a look back at 2021, it was 27 days. If I go back a little bit further, just like 4 months, into 2020 or even into 2019, they're 38 months, 42 months, okay? So we are still doing incredibly well. We are going to see a little bit of a slowdown, okay? It's kind of like having that really super tight balloon, and you're going to let a little bit of air out of it, okay? and it's going to come down into something that's not quite as taut. Okay, let the steam out, as they say. Just take some of that pressure off. And that is what this is going to do, which will help to actually bring a more healthier market to the people, both in buyers and sellers. Because a lot of the buyers out there are saying, dude, what's the matter with these sellers? Why aren't there more homes out there? I'm like, because they have no place to go. So if we can create more inventory for them and give them, move up options, move down options, maybe they'll keep their home as a rental, which doesn't help anybody except for them. But nonetheless, if we're able to create that additional inventory, because people now have an opportunity of where can I move to, then we actually create a healthier, balanced market, which is sustainable. And that is really what we want at the end of the day. Okay? Because right now, if the feds get what they want, they actually, when they look at interest rate neutral for lending, they're trying to curb that 5.4 to 7.8% inflation, depending on which metric you're looking at, that is impacting people and our economy. So they're trying to mitigate that, and we'll see what happens. For those of you that are out there looking, hey, just remember, for every $500,000, you took a haircut of $537. If you guys want to revisit what you guys were watching, the video from last week, and remember, May 1, TikTok 1 month. If you have student loans, you need to start paying your student loans in 1 month. Heads up, keep that in mind. In the meantime, if you guys have any questions, let me know. You guys have an absolutely beautiful day. Keep posting those questions. Love to respond to them. Love to hear what you guys are having to say. If there's any question you have, ask. There's no strings attached. In the meantime, I will catch you guys on the next video. Take care.